Global trends and winners, how world events shift financial markets, and how to identify the specific companies or sectors positioned to profit. Geopolitics, the impact of international relations, trade deals, and global conflicts on markets and trade. Corporate governance, how companies are managed, focusing on the leadership, rules, and ethics that drive honest efficiency. The RBI gold reality, the actual strategy behind the Reserve Bank of India's 880-plus ton physical gold safety net during global financial stress, separating fact from internet rumors. In short, the video explains how global politics, corporate management, and India's gold reserves intersect to reshape the economy, and how you can spot the winners. We're going to start by looking at the truth about India's gold savings. There is a lot of fake news and gossip out there right now, so we're going to clear that up by looking at the actual facts and history of India's emergency funds. The RBI gold reality. The Reserve Bank of India, RBI, holds a massive amount of physical gold, over 880 tons. Recently, there have been viral rumors that the RBI secretly sold off billions of dollars worth of this gold. The reality part means looking at the truth, which is that the RBI hasn't sold it, and the physical amount has stayed exactly the same. Separate market rumors from historical facts. This simply means cutting through the gossip and fake news, the rumors, and looking at the actual data and official history, the facts. Foreign exchange reserves. This is essentially a country's rainy day fund. It is a massive stash of foreign money, like US dollars, gold, and other assets, that the RBI keeps on hand to protect India's economy if something goes wrong in the world. In short, the video is kicking off by debunking recent fake news about India selling off its gold, and instead explaining how the RBI is actually managing the country's emergency wealth. Recently, a massive rumor went viral claiming India's central bank secretly sold off billions of dollars of its gold. People thought they did this to stop the Indian rupee from losing value, but the government stepped in and proved this story is completely false. The $12 billion rumor. A recent news report from Bloomberg claimed that the Reserve Bank of India, RBI, quietly sold off a massive chunk of its gold stash, about $12 billion worth, defending the rupee. When the value of the Indian rupee drops too low compared to the US dollar, which makes importing things like oil much more expensive, the RBI sometimes steps in to defend it. They usually do this by using their emergency cash reserves. The rumor suggested the RBI was so desperate to protect the rupee that they resorted to selling off the nation's gold to get the cash needed to do it. Dismissed as fake news. The Indian government and the RBI quickly put out official statements saying this never happened. They released the actual data showing that not a single ounce was sold, and India's physical gold savings, over 880 tons, remain completely untouched. In short, because the government has confirmed that India's gold reserves are safe and were not sold off to rescue the currency. When we look at the actual records, the Reserve Bank of India has consistently been buying gold, not selling it. The actual amount of physical gold they hold keeps growing or staying steady, which completely destroys the rumor that they are dumping their gold reserves. Steady net buyer. This means that over a period of time, like a year, the RBI buys more gold than it sells. In fact, data shows the RBI has been consistently adding to its gold reserves for the last few years. Physical volume accumulation is consistent. Physical volume means the actual physical bars of gold, measured in tons, not just the dollar value on a spreadsheet. Accumulation means piling it up. So this just means the actual pile of gold India owns, which is currently over 880 tons, is steadily getting bigger, or at least staying the same. Refuting any narrative of a massive physical sell-off. Refuting a narrative is a formal way of saying proving a story is false. Because we know the physical pile of gold is growing, it proves that the rumors of the RBI secretly selling billions of dollars worth of gold are completely fabricated. In short, the math simply doesn't support the rumors. The RBI is a gold hoarder, not a gold seller, and their vault is as full as it has ever been. The really big news isn't that India is selling its gold. It is that they are bringing it all back home. Over the last couple of years, the RBI has moved a massive 680 tons of its gold out of foreign vaults and placed it into highly secure vaults right here in India. Repatriation, not liquidation. Repatriation means bringing something back to its home country. Liquidation means selling something off for cash. So the RBI is focused on bringing its gold back to India, not selling it off. Reversing the 2020 trend. In the past, it was normal for India to keep a huge portion of its gold overseas for safekeeping, often with the Bank of England in London. Now, the RBI is doing the exact opposite. Aggressively moved 680 tons. This highlights the sheer scale and speed of the move. Moving physical gold across the world is a massive, highly secretive logistical operation involving heavy security and insurance. Out of their total reserve of about 880 tons, the RBI has now safely secured over 680 tons inside India's borders. Secure domestic facilities. These are the high-tech, heavily guarded vaults within India, like the ones in Mumbai and Nagpur, that have been upgraded to meet strict international security standards. In short, India isn't desperate for cash. Instead, the country is quietly pulling its wealth back inside its own borders to protect it from global uncertainties and foreign control. Next, we will explore the macro pressures and governance issues, understanding the broader economic headwinds currently shaping the market. The economy is facing some serious roadblocks right now. Wars in the Middle East are threatening our oil supply, and gold prices are jumping all over the place. On top of that, the massive Rajesh export scam shows us that some big companies are faking their numbers, and the system meant to catch them completely failed. Economic headwinds. Think of a headwind when you are riding a bike. It is the wind blowing directly against you, slowing you down. In finance, these are the negative global forces making it harder for the economy and the stock market to grow. Geopolitical oil strain. Because of the ongoing wars and political tension in the Middle East, the global supply of oil is at risk. For a country like India that imports a massive amount of its oil, any disruption means higher fuel prices, which ultimately drives up inflation and the cost of doing business. Valuation volatility in gold prices. Volatility just means wild, unpredictable swings. Gold prices have been bouncing up and down so drastically that it is very difficult for the market to figure out what it should actually be priced at, its valuation, on any given day. The Rajesh export scandal, corporate fraud. This refers to the massive breaking news from June 2026, where SEBI accused Rajesh Exports, one of India's biggest gold and refining companies, of faking roughly 15 lakh crore rupees in revenue over several years. Corporate fraud simply means the executives were allegedly lying about the company's financial reality to trick the market. Institutional failure. This is the brutal truth of the situation. It means the safety nets did not work. The statutory auditors and the financial institutions whose entire job is to verify a company's balance sheet and protect everyday retail investors completely missed a 15 lakh crore revenue hole until a single shareholder finally complained. In short, the market is dealing with expensive oil, chaotic gold prices, and a stark reminder that you cannot always blindly trust the numbers a company reports on its income statement. We now turn our focus to strategic beneficiaries. Which companies are positioned to gain from these major macro trends? Because of the global oil shortage and high crude prices, companies like ONGC and Oil India are making massive immediate profits. They dig the oil straight out of the ground, so when global prices shoot up, their costs stay about the same, but their selling price skyrockets. Upstream oil producers. In the oil industry, upstream refers to the companies that do the raw, heavy lifting. They explore, drill, and pump raw crude oil out of the ground. Unlike downstream companies, like petrol pumps that have to buy oil and refine it, upstream companies like ONGC and Oil India own the raw product from day one. Key beneficiaries, the winners. These are the specific companies that stand to gain the most money from the current global situation. Restricted global supply and elevated international crude prices. Because of wars and political tensions, especially in the Middle East, there is less oil moving around the world, restricted supply. When supply drops, but everyone still needs oil, the global price per barrel shoots up, elevated prices. Immediate profit margin expansion.
This is the best part for these companies. It costs ONGC a relatively fixed amount of money to pump a barrel of oil out of the ground, let's say $40. If the global price of oil jumps from $70 to $90 a barrel, ONGC can immediately sell that same barrel for $20 more. Their costs didn't go up, but their revenue did, meaning their profit margin instantly stretches out. In short, while high oil prices hurt everyday consumers at the petrol pump, they are fantastic news for upstream companies like ONGC and Oil India who get to sell their raw oil to the market at a premium.
Two completely different industries are about to make a lot of money right now. First, the heavily armed transport companies moving India's gold back home are getting massive contracts. Second, because of recent massive corporate scams, financial detectives and auditing firms are seeing a huge boom in business as companies scramble to prove they aren't faking their numbers. Secure logistics providers, BVC and Brinks. These are not your average delivery drivers. These are highly specialized, high-security transport companies that move extreme wealth, like physical gold bars, using armored trucks, specialized cargo planes, and heavily armed guards. Surge in demand due to gold repatriation. Because the RBI is actively moving hundreds of tons of gold back to vaults inside India, repatriation, they have to hire these specialized transport companies to physically move the metal. Moving that much gold is a massive, highly insured logistical operation, which translates to huge paydays for companies like BVC Logistics and Brinks. Forensic auditors and ratings firms. Regular statutory auditors just check if a company's balance sheet balances. Forensic auditors are financial detectives. They dig deep into the income statements, bank records, and data to find hidden fraud, shell companies, or fake revenue. Ratings firms are agencies that grade how safe and well-run a company is. Increased governance demands following corporate fraud. After massive scandals, like the Rajesh Exports fake revenue issue, everyday retail investors and regulators have realized the standard safety nets are broken. The brutal truth is that nobody trusts a basic audit anymore. Regulators are now demanding much stricter oversight, better corporate governance. To prove their numbers are actually real, companies are being forced to hire these financial detectives, creating a massive influx of new business for forensic auditors. In short, the secondary winners in the market. The money isn't just in the gold or the oil itself. It is in the companies hired to transport the gold and the detectives hired to clean up the corporate fraud.
Even though the RBI isn't adding more gold to its vault right now, the global price of gold has skyrocketed. This means India's existing gold stash is suddenly worth over $120 billion. Because gold is so valuable right now, the financial companies that give out gold loans are in a perfect position to make a lot of money. Physical volume is flat. This means the actual physical amount of gold the RBI owns hasn't really changed recently. They are sitting steadily on about 880 tons without buying much more. The global gold rally and valuation. A rally means a massive, rapid surge in price. Even though the RBI has the exact same number of gold bars, the worldwide price of gold has shot up so high that the total value, the valuation of India's stash has crossed the $140 billion mark. Tailwind. Think of a tailwind when you are riding a bike or flying a plane. It is the wind at your back, pushing you forward and making you go faster with less effort. In business, a tailwind is an external positive trend that helps a company grow easily. Gold Finance NBFCs. NBFC stands for non-banking financial company. These are financial institutions that operate a lot like banks but don't hold full banking licenses. Gold Finance NBFCs, like Muthoot Finance or Monoperm Finance, are companies whose main business is giving everyday people cash loans in exchange for holding their physical gold jewelry as collateral. In short, why the rising price of gold isn't just a win for the government's balance sheet, it is a massive immediate boost for local loan companies. Because the gold they hold as collateral is suddenly worth significantly more, their businesses become much safer and more profitable. Because gold is getting so expensive, the companies that give out gold loans are growing rapidly. The rising price of gold acts as a massive safety cushion for their balance sheets, ensuring their loans get repaid and proving to the market that these stocks are highly reliable investments right now. A powerful growth engine. When the price of gold goes up, a borrower can get a much larger loan for the exact same gold bangle or coin. For companies like Muthoot or Monoporum, this is incredible news. It means they can disperse more money and earn more interest income from their existing customer base, driving massive revenue growth without having to spend heavily to acquire new borrowers. Improving the margin of safety. When an NBFC issues a gold loan, they are regulated on how much they can lend, typically capping out at 75% to 85% of the gold's current value, the loan-to-value ratio. If the global price of gold suddenly skyrockets after the loan is given, that loan might now only represent 50% or 60% of the gold's new, higher value. If the borrower defaults, the NBFC has a massive cushion. They can auction the gold, recover the principal and the interest, and not lose a single rupee. Enhancing asset quality. In the banking sector, an asset is a loan given to a customer, and asset quality refers to whether those loans are actually being paid back rather than turning into non-performing assets, NPAs. When gold prices rally, borrowers realize their pledged jewelry is suddenly worth significantly more than the cash they owe. This creates a massive psychological and financial incentive for them to absolutely ensure they pay back the loan to get their valuable gold returned. Strategically validating gold finance as a stable play. A stable play is a reliable, low-risk investment. You are concluding that while the rest of the market might be panicking over inflation or expensive oil, the fundamental mechanics of gold NBFCs make them a safe harbor. The rising gold price literally bulletproofs their business model. The brutal truth of the balance sheet. Gold NBFCs aren't just surviving global economic chaos. The chaos itself is actively making their loan books safer and more profitable. Muthoot Finance and sector profit drivers. This discussion with Muthoot Finance Management offers great real-world context on how soaring gold prices are actively driving loan demand and strengthening the sector's financial footing. Thank you for watching this video on market trends and strategic beneficiaries.